I want to cut to the chase on the economic gloom right now. You're at 2.6-ish%. Life's going to go on. Yield's going to go back up 3-ish% or so. What does the gloom crew get wrong right now?
Well, I think there are a few things. First of all, the yield curve hasn't inverted. So this whole idea, I mean, I come into work and people are like, the yield curve's inverted. It actually hasn't. So we're not quite there yet in terms of that factor signaling that there's a risk of recession. Productivity is accelerating, which is not normal in the late stages of a cycle. So you can either believe we're in the late stages of the cycle and productivity is doing something odd, or that productivity is behaving the way it normally does in the middle point of a cycle, and we've got a few years left to go, which is kind of my preferred way of thinking about that. Then finally, if you look at economy-wide profit margins, they've been pretty much stable at like 11%, and they seem like they're going to be stable at 11% for quite some time. We've got a lot of job growth, and so even if there is uncertainty in the world and CEOs pull back on hiring plans, you'd have to pull back on hiring plans a lot in order to get the number of job openings down to the number of unemployed.
We're going to talk about the stock market with you later. We've got Kevin Surley coming up on the festivities in Washington on immigration as well. How do you respond to an economy's dynamics and its political leader? Can President Trump help or hinder this economy, or is it really a sideshow to the dynamics, the animal spirits of American corporations and households?
Well, so I do think that the animal spirits matter most. But I do, when you think about financial markets, they have been impacted by uncertainty. A lot of that uncertainty is coming from trade, whether it's on China, U.S. and Mexico, Canada, and now Europe, and ongoing. So people don't know how to price uncertainty, particularly political uncertainty. And so then it becomes somewhat more important to markets than actually the underlying dynamics. And sometimes then the underlying dynamics get lost. So I think, for now at least, I think the smarter thing to do is to kind of look through all the noise and look at the underlying fundamentals of the U.S. economy, which are best reflected in the U.S. consumer, who's doing quite well.
Drew, do you worry about a policy mistake from the Fed, so hiking too soon?
I always worry about a policy mistake from the Fed, but I would say the bigger mistake is that they wait too long to continue hiking. I think when you're looking at the growth that we're seeing, inflation's pretty much at their target level. You have unemployment well below kind of where people think is traditionally normal. And so what they have to really watch out for is that first sign that inflation's picking up, because if we sense it before they do, and they're not moving, then we're going to sense that they're getting behind the curve. And I think that's a risk that they run, and it could lead to yields moving up more quickly than anticipated, which would then be detrimental. Rising yields is fine. Rising yields because we feel like they're behind the curve on inflation would not be.